Hey everyone, let's dive right into this explainer covering the billionaire's paradigm shift, Warren Buffett's core philosophy. When we picture the world's most successful investors, right, we usually imagine people with some sort of crystal ball, a magical ability to predict exactly what the market is going to do next. But what if the greatest investor of our time built his $100 billion fortune by doing the exact opposite? We're kicking things off with a pretty fascinating confession from the legend himself. Buffett literally admits, I had the whole wrong idea. I thought stocks were things that went up and down. It's honestly so refreshing to hear that, you know? The man, basically synonymous with wealth generation, started out making the exact same fundamental mistake almost every beginner makes today. He was entirely focused on the price tag, completely missing what that price tag actually represented. Section 1, the 11-year-old investor. Let's trace this back to a young boy in 1942 to see where this journey actually began. $14.75. That specific amount is what an 11-year-old Buffett scraped together to invest in just 3 shares of Citi Service Preferred. It was March 11th, 1942. He says he took absolutely every penny he had saved up in his young life thus far and poured his entire net worth into this single decision. And this is the seed of a $100 billion fortune. It brilliantly illustrates how a tiny seed, even though it was initially planted the wrong way, would eventually grow into this massive empire. You see, the desire to go big, the absolute fascination with the market, that was there from the very start. But his methodology? It was completely upside down. So for his first 8 years, from age 11 all the way to 19, he went about it exactly the wrong way. He was obsessively charting prices, reading technical analysis, trying to predict the market's every little move. He was reading these massive classic books on technical analysis by Edwards and Magee, hundreds of pages. He read Garfield Droop, literally everything he could get his hands on, reading the same texts over and over again. His whole worldview was based on this one deeply flawed premise, that the most important thing you could possibly do was predict what a stock or the overall market was going to do next. Which brings us to Section 2, the billion-dollar paradigm shift. This massive epiphany hit him at age 19 when a book by Ben Graham completely rejiggered his mind. Just look at the stark contrast here between his old, super stressful habit of predicting stocks, hoping prices go up next week, versus his new, peaceful strategy of actually owning businesses, buying a piece of a company for the long run. When he read Ben Graham's book, The Intelligent Investor, he realized his entire approach was completely backwards. From that exact moment forward, Buffett says he never bought another stock. Instead, he bought businesses that just happened to be publicly traded. He stopped caring entirely if the stock went up or down the next day, week, month, or even year. He realized, hey, I don't know what the stock market is going to do, but I do know how to evaluate a successful business over the long run. Moving into Section 3, think like a farmer. This new paradigm shift requires stepping away from the ticker tape and looking through a much calmer lens. And that brings us to this wildly counterintuitive quote from him. I'm happier when stocks are going down. Now, he points out that 90% of people who buy stocks feel terrible when the market drops, mainly because they're treating it like a gamble they hope just pays off next week. But Buffett, he feels better. Honestly, he hopes it goes down. So, you've got to ask, why would a billionaire want his investments to drop? It sounds absolutely crazy at first glance, right? Why on earth would a wealthy investor want his own net worth to temporarily shrink? Why would you want the asset you're buying to instantly lose its quoted value? Well, he explains it beautifully with this farmland logic. If you're a farmer, you actually want land prices to fall so you can buy more acreage for way less money. Buffett suggests we should pretend the stock market doesn't even exist. Instead, imagine you're buying a private farm or a private apartment building. You just want to put your saved money somewhere so you can get it back later, right? So, if you're actively buying into a great business, a drop in the stock price simply means you get to buy more of that incredible business with the exact same amount of money. When you look at it like that, it just makes fundamental sense. Section 4. Temperament over high intelligence. You might assume you need to be some sort of mathematical genius to pull this off, but the numbers tell a totally different story. As it turns out, an IQ of 120 is plenty to be a highly successful investor. In fact, having a genius-level 170 IQ might actually make you perform worse, no joke. Buffett openly admits that if he had gone into physics or advanced mathematics, he would have been an also-ran, but investing? It's a game where extreme raw intellect just isn't the deciding factor. The absolute crucial point here is having the right orientation. You need the emotional temperament to completely ignore the daily panic, to view your stocks as private apartments, and to play a game you can actually win over time. Like 90% of people just can't figure this out because their orientation is all wrong. They're so desperate to win tomorrow. But Buffett, he plays a game he knows he can win over a lifetime. You literally just need to have the right lessons locked in your mind about what it is you're actually buying.
Section 5. The Great American Engine. Let's look at the massive historical tailwind driving this entire philosophy.
Buffett has maintained this immense, unwavering faith in the American economic engine, literally never holding less than 80% of his money in American business at any given time. From the second he bought those first 3 shares back in 1942 up to right this very minute, his wealth has been overwhelmingly anchored in the U.S. economy. He doesn't even like calling them stocks. To him, they're pieces of American business. To really grasp why he's so confident, just think about John D. Rockefeller. When Buffett was 6 years old, Rockefeller was the wealthiest human alive on the planet. Yet, when the guy went to the dentist, they didn't even have Novocaine. Ouch. If he wanted to watch a football game, he had to physically travel there. Today, you and I sit in front of massive high-def screens with instant replays telling us exactly what just happened. The foundational work of this economy has raised the standard of living so incredibly high that everyday people are living way better than the billionaires of just a few generations ago. It is a staggering historical fact. Just half of 1% of the global population, working totally regular hours with the exact same IQ as everyone else, somehow generated over 20% of the world's bounty in just a few lifetimes. It's a 200-year miracle. Buffett loves to say that if you traveled back to the Constitutional Congress in 1789 and told them what this country would look like in just 3 lifetimes, that people would be flying through the skies and watching global sports in real time, they would have hauled you off to an asylum. The people here didn't work harder than the rest of the world. But over a couple of centuries, they built an economic machine that is absolutely unparalleled in human history. So as we wrap up this explainer, I want to leave you with this provocative question. Look at what an hour of your labor buys today versus what it bought a century ago. It's almost unbelievable, right? We are all the lucky beneficiaries of the incredible things inventors and businesses have created. So the ultimate question for you is, are you treating your money like a casino chip, just hoping for a quick pop next week? Or are you ready to completely rejigger your mind, think like a farmer, and actually invest in the long-term progress of great businesses?